Hi, everyone. Thank you for patiently waiting. My name is Tom Wall, a senior associate here at Kay Properties, and thank you so much for joining us for DST Essentials with Kay Properties, where we take an in-depth look at the different aspects of the DST 1031 exchange investment process. We'll be getting the call started with a few risks and disclosures. DST 1031 properties are only available to accredited investors, which are generally described as having a net worth of more than $1 million, not including their primary residence, and accredited entities, which are generally described as an entity either owned entirely by accredited individuals or an entity with gross assets of greater than $5 million. If you're unsure whether you are an accredited investor or if you have an accredited entity, please verify with your CPA and attorney. The information herein has been prepared for educational purposes only and does not constitute an offer to purchase securities, DST properties, or real estate. Such offers are only made through a private placement memorandum or PPM, which are solely available to accredited investors and those with accredited entities. Securities are offered through FINEX, member FINRA, and SIPC. FINEX and Kay Properties are separate entities. This material is not to be interpreted as tax or legal advice, so please speak with your own tax and legal advisors for guidance regarding your particular situation. There are risks associated with investing in real estate and Delaware Statutory Trust or DST properties, which include but are not limited to the loss of entire investment principal, declining market values, tenant vacancies, and illiquidity. Investors should read each PPM carefully before investing, paying special attention to the risk section. Because investors' situations and objectives vary, this information is not intended to indicate suitability for any particular investor, so please speak with your CPA and attorney to determine whether an investment in real estate or DST properties is suitable for your particular circumstances. Past performance is not indicative of future returns, so potential cash flows, returns, and appreciation are not guaranteed, could be lower than anticipated. Thank you, everyone, for listening in. Now I'd like to turn the call over to Tommy Olson, Vice President with Kay Properties and Investments.
Thank you, Tom. And hi, everyone. Thank you so much for joining us today. We're going to have a great time today on DST Essentials with Kay Properties, where we take an in-depth look at the many recurring themes and nuances to the DST investment process. In this series, we'll be interviewing many members of the Kay Properties team who each bring their own unique and valuable perspective that they formed over their vast transactional experience in the DST investment landscape. Before I introduce our special guest today, I'm going to start with a little bit about Kay Properties. Kay Properties is a national Delaware Statutory Trust DST investment firm. The www.kpi1031.com platform provides access to the marketplace of DSTs from over 25 different DST sponsor companies. This includes custom DSTs only available to Kay clients and an active DST secondary market listing. Kay Properties team members collectively have over 150 years of real estate experience and are licensed in all 50 states and have participated in over $30 billion worth of DST 1031 investments. I'm very excited to have our very own Matt McFarland on the call today. Matt is a senior vice president, works out of our Kay Properties headquarters office in Los Angeles, California, helping clients with their 1031 exchanges and direct investments. Since joining Kay Properties, Matt has participated in over 1,300 transactions and over $15 billion worth of real estate. Matt works hand in hand with all the Kay Properties executive vice presidents, educating clients on what particular investments make sense for their situation. Today, we're going to be discussing a very specific case study on a recent 1031 exchange transaction completed by a family out of Northern California. Our goal is to provide insight into how decisions was made and to initially pursue the DSTs and how the investment process was approached and eventually completed. Matt, welcome to the call, and thank you for being with us.
It's my pleasure, Tommy. Thank you for hosting.
Yeah, my pleasure as well. So let's begin with some context, Matt, on this particular investor. Can you provide us some brief background information about their situation?
Absolutely. So this case was initially began very similar to many other cases that we work with. The investor initially approached us, hoping to learn more about the DST structure. They had a 1031 exchange out kind of in the distance, nothing, immediate. This was early summer 2021 when we began early conversations, and really just kind of dove headfirst into education with them. We learned a little bit about their situation. A large family investor out of Northern California, own a number of larger industrial and other commercial properties. There was some legal background, so a little bit higher level of sophistication kind of right out of the gates. But in terms of the education, it really began with them really, wrapping their arms around the structure, to figure out if this was or if this would be a viable solution or option for them to consider once they were in a 1031 exchange in the future. When they approached us, once again, they didn't have anything, an immediate need, but knew that they would, in the years to come. So education, starting with many kind of individual conference calls, answering specific questions. They attended our webinars, Friday calls like, we're hosting today. We even went through a number of PPMs and kind of dove into some of the more nitty-gritty details. Once again, all with the goal to figure out if this, was a viable solution for them. And so, over, 6 to 12 months, we kind of slowly went through that process with them, and kind of the net result, which we'll get into, is them actually kind of moving and kind of selling one of their properties and pursuing DSTs as a result.
Oh, that's really great background information, and that's so cool that these calls were what really helped them get comfortable with this structure and start to understand it more as, part of the education process for them that really spanned, sounds like about a year time period. So, and you also mentioned the webinars. In case any listeners haven't attended one of those webinars, here on the Friday conference call, we're going to dive deeper into different nuances of the DST investment process, but that Wednesday webinar is really the basics course. That's the 101. So attend on Wednesdays at 11 a.m. Pacific time, 2 p.m. Eastern time, and you can get the introduction to the DST 1031 exchange. But here we're gonna do something different every week. So just kind of do a little plug for that there. So what did they actually end up selling, Matt? Which property was it that they chose to dispose?
Yeah, so they actually sold a larger industrial property that they've owned for many, many years out of Northern California. Just a few details on the sale. So I mentioned they first engaged with us in early summer 2021. The sale was not finalized until fall of 22. So it kind of spanned about 15 months from the time they first engaged to the time that they actually were in, a relevant position to consider specific DSTs, which I think is pretty cool, just the amount of time. And that's not uncommon. We have investors that approach us with an exchange maybe right in front of them in a month, 2 months, 3 months. We have investors that have been engaged with us for 4 or 5 years before they actually transact. So I think that's a powerful testament to kind of the educational process. But anyways, shifting gears back to the sale. So this larger industrial property, they owned all cash. It sold for a little bit less than $10.7 million. The family decided to take $650,000 in boot and pay tax on it. They had some liquidity needs, for various reasons. And so what it all came down to is they had about $9.5 million that was sent to a qualified intermediary to conduct, a 1031 exchange. And typically when whenever we're dealing with, this sum of money, or, an investor is dealing with a larger sum of money, obviously they have many more options that they can consider with respect to purchasing power, right? $9.5 million can go much further than an investor who's considering an exchange for $400,000 or $500,000, right? So they were certainly considering all their options, as they should. They were considering buying another, kind of triple net or net lease type property, multiple triple nets that they could, manage on their own. They were considering DSTs and, a number of other approaches. And, really ultimately what led them, to DSTs was the fact that, one, they couldn't get comfortable with what was available kind of more on the traditional side, with respect to cap rates and opportunities that were available, in the market at that time. And then on top of that, like many DST investors, they really wanted to hedge concentration risk, and really, really wanted to stay debt free. And they were able to do that, much more easily by taking smaller positions in a number of DST properties. I think in addition to that, the quality of property that they were able to access on a fractional partial basis in a DST was even much higher than what they would be able to access, with the $9.5 million that they had in the exchange. And then the last thing, kind of the last aspect too was, management. I think, there was definitely a concerted kind of push and decision that was made to kind of take more of a backseat to active management. So, all of that ultimately led them in the direction of DSTs. And we'll kind of talk a little bit more about how that whole process went in terms of the investment. But that's a little bit more context in terms of the transaction and the ultimate decision that was made.
That's great. So, avoiding concentration risk, and then the benefit of diversification with the DSTs, that's something that is really important to a lot of our investors, and I'm glad you brought that up. But you brought something else up, which, they said they wanted to stay debt-free with these DSTs. It sounds like they have a lot of other assets. This isn't, their whole kind of net worth in, this one exchange. And so why was it for them in particular that it was important for to stay debt-free in this exchange? Couldn't they have taken some additional risk with adding some debt and then, had some potential benefits there? And where were they coming from?
Yeah, good question. So like I mentioned, this was a family exchange. And, I think what it came down to with respect to the decision to stay debt-free is they were ultimately, they're at a position as a family where, they have created enough wealth that they're less focused on, squeezing everything out of their real estate as it relates to tax efficiency and the potential benefits that debt could bring, which there certainly are, benefits of taking on debt. But for them, the higher priority was positioning for principal preservation. And ultimately, there's a much higher chance of that by staying debt-free. And they understood that. On top of that, it's the DST structure can pose certain limitations as it relates to the financing or refinancing in the future, which was a risk that we had kind of discussed with them. And I think, we were all in agreement that the debt-free approach was what ultimately made sense to them at the time. I think also, just to provide additional context, this transaction, took place in the very end of 2022. There's a little spillover into 23 as well. But I think there was also kind of a greater concern in terms of timing of when they're entering, back into the real estate market. Real estate has performed very, very well. We've been definitely at a very high point in the cycle. And so I think there was concern where they wanted to position for ultimate holding power. And, that holding power is most easily achieved in an all-cash setting where there's no worry about any loans coming due, anything that could influence an early sale that could impact, the value of their position in that DST at disposition. So there are a lot of different components to it, but that was ultimately kind of what they based their decision on.
That's really helpful. Thanks for explaining that. And then, so what was it? And I imagine that might have been part of it, the access that we get to debt-free product here at Kay Properties. But why would you say that they ended up choosing to work with Kay Properties? And with what was their investment approach when, they came and they said, okay, hey, we want to move forward working with you, or how did that go, Matt?
Yeah, good question. We mentioned it, access to, an array of different offerings. We do specialize in some way with the debt-free DSTs. We have considerable access to those through the various relationships that we have in the space. I think on top of that, our philosophy in terms of how we approach the investment space was really something that they agreed with. So there was, we kind of saw eye to eye with the overall approach. Beyond that, just the kind of the knowledge that we brought to the table and experience that we had relative to other companies that offer DSTs, I think really was what did it for them. In terms of deciding to work with Kay Properties, we were just able to provide them so much more experience and then ultimately access into properties that were relevant for them. And I kind of want to, with that, jump into their approach, which I think was really interesting and kind of unique with respect to the timing of their transaction and the total value of the transaction as well. So, instead of lining up a number of different DSTs and immediately, closing on, those DSTs and kind of putting the exchange in the rear view, which is what, many DST investors will do. I think for them, they decided to take more of a gradual and systematic approach to investing over a little bit of a larger expanse of time. Part of this was because during the 45-day identification period, they were, still keeping their eyes open to other opportunities. So what they decided to do is, they kind of systematically and gradually would close on smaller increments into DSTs throughout the 45 days. And then we actually helped them identify a number of options using the 200% rule, where they would have the ability to not only come back to some of the properties that were available within their 45 days that would likely still be available beyond day 45, but also there were a number of kind of upcoming projects that weren't officially available yet within their 45 days that they could have interest in that we actually identified as well. And so we kind of structured their ID sheet in such a way where we identified a number of different opportunities where they can kind of pick and choose after the 45 days based on what actually came available and, what they ultimately decided on with respect to the remaining proceeds. And it actually worked out really well because they were able to close on about half of their exchange value within the 45 days. The other half was closed on after. And so under the 200% rule, because they were identifying all debt-free DSTs, we were able to really max out that identification sheet and provide them so many different options with that last, call it, $4 or $5 million that they had to place. And a number of the deals that we actually had them identify, at least one or two of them, they actually didn't end up coming to fruition. There was something that came up in the sponsor's due diligence that, led them to not go forward with the closing. But we were so insulated with respect to all the different kind of alternative pathways that we could go in terms of how we structured the ID sheet, that they still had plenty of options to consider. And so start to finish, from the first purchase of, their initial DST all the way to the last purchase spanned about 3 months or 90 days, which is longer than most DST investors, and it's not necessarily an approach that we encourage, all investors to do. It just so happened with, their situation, we were able to walk alongside them and operate in a way that was ultimately provided flexibility for them and in a way to match the specific approach that they wanted to take, right? And I think that's a huge benefit to the DST structure, is we have so much more flexibility because of the fact that these properties are prepackaged. They're built specifically for 1031 exchange investors. And then on top of that, with, the Kay Properties platform, we have access to so many different offerings that could potentially be compelling to a given 1031 exchange investor. So, all in all, they ended up buying 9 different DSTs in the process, and were able to ultra diversify across a number of different asset classes that they were ultimately comfortable with.
Wow, 9 different DSTs, and you said they had about $9 million. So was that about $1 million per DST, or do they kind of custom tailor fit it according to their, they liked something more than another?
Yeah, good question. I mean, there was definitely some customization that took place. There were certain properties that they decided to allocate a little bit more to than others, and that had to do with a number of different reasons. I'll give a quick example. One of the properties that they identified was actually a portfolio DST. So there were multiple properties bundled into one, DST package, and something like that they were comfortable allocating a few more dollars to versus maybe a smaller kind of single asset DST where they decided to pare back a little bit. So it's actually, is a little bit more customized, which is, kind of what we were talking about before, with the flexibility of being able to decide exactly how many dollars our investors want to allocate to specific real estate deals, which I thought was really interesting, and for this transaction specifically.
Yeah, definitely. And 3 months or so to finish. We see people finishing a 1031 exchange in the DST property sometimes in 3 days. So I guess this one kind of probably felt a little bit dragged out, but it's great that they were so systematic, and it kind of reminds me of the way that that you think and work, Matt, yourself. I'm sure you're a good fit for them and their family because you're a very systematic thinker and have a logical approach and intentional with the decisions that you make. So I'm glad that you were able to help them. What types of properties did they actually invest in? What sort of diversification did they get across different asset classes?
Yeah, good question. I appreciate the kind words, Tommy. And I think, I will agree with you. This is not an approach that we necessarily encourage, for most investors to take. For them, it was what they were most comfortable with. And, we had talked about the closing risk that's apparent whenever we go beyond, the 45th day. And that's certainly not something that we take lightly, but ultimately, it was what they were most comfortable with. And so that's kind of what I want to stress here is, ultimately this is their money, right? This is our investors' money. We're not the ones that are deciding when and how that money is invested specifically. We're partnering with our investors, offering our advice, walking alongside them in a manner that they ultimately feel comfortable with, but also interjecting and offering valuable insight into kind of, timing and approach and how everything works based on our experience and our unique positioning, in the DST space. So just wanted to mention that. In terms of the properties they purchased, so I mentioned, 9 different DSTs. They purchased a couple of self-storage properties, a couple of distribution and industrial facilities, multifamily, a pharmacy, retail properties, even built for rent, single-family home communities. So definitely a very, very diversified spread. And we kind of stuck to more of the core, more predictable asset classes. Of course, we have some storage and multifamily that tend to provide a little bit more potential for, growth and upside in the long term, maybe a little bit more potential volatility with respect to cash flow. And then some of the more long-term single-tenant net leased type properties, which would be kind of that distribution industrial, pharmacy properties, other commercial type buildings to provide that stable base for them. So all in all, definitely, they were able to access a significant amount of diversification, through taking positions in, so many different DSTs, with so many different asset classes in different parts of the country that ultimately are positioned, uniquely and separately, but all contribute to this greater, tax-advantaged real estate portfolio that they were able to move into through the DST structure.
Very nice. Cool. Thank you. So they kind of took that anchor and buoy approach like we talk about here with having the stable, solid, long-term net leases, and then a little bit of an upside on the storage and the multifamily and built for rent, sounds like. So great. But that was their decision ultimately, like this whole thing, like you're talking about, where, we can provide guidance, talk from our experience, but at the end of the day, it's the investors who are the ones who get to decide for themselves what they're going to do with their exchange. And so is there anything else that you wanted to add, Matt? Because I think that, what this leads into, kind of a segue, is, reaching out to someone's registered representative if they haven't already done so, and kind of had a conversation with a Kay Properties team member, and finding out how they can leverage that experience for their own situation. But what would be some good questions to start with for them in that conversation, Matt? What do you suggest?
Yeah, good question, Tommy. I think just continuing to push as it relates to education, right? That's something we're really, really big on at Kay Properties. We really want to make sure that this is the right fit for the investors that we're working with. And the only way we're going to be able to do that is to have engaging conversations with prospective customers to understand, not just their situation, but have them understand, what we're able to provide And that's a combination of, really kind of wrapping their arms around the structure of the DST, but also looking into our platform, right? And what Kay Properties can specifically provide to them as it relates to DSTs, so that we can get to a point where the investor is very clearly informed and at ease as they lead into their 1031 exchange transaction. So would really encourage, everyone on the call, please reach out to your Kay Properties representatives. We're here to answer questions. We're here to provide insights, and, continue to engage with us in formats like this. Hopefully, this conversation was helpful today, and other conversations we've had in the past on these Friday calls, Wednesday webinars, various, webinars and events that we host. We all do this, ultimately to get the word out on DSTs and to provide that valuable education for investors. So that would be kind of my call to action here at the end.
That's great. Yeah, thanks, Matt. So keep listening. Tune in every Friday to the DST Essentials conference call. And if you want to listen to past episodes, then choose your podcast provider and look for Kay Properties DST Essentials there. You'll be able to listen to over 75 different recorded episodes that have been, in most of them, with our very own Matt McFarland as the host, interviewing different team members from the Kay Properties team here. And then also, read those PPMs. Very exciting, very entertaining for you. And then read through our blogs, which are also, I think, written reader friendly. And ask questions and call up your representative. Come meet us in person. If you don't live in Torrance or Southern California, that's okay. We can come to you, and we're happy to do that and just to continue the education process. So thank you again, Matt. Thank you so much for joining us today. We appreciate your time, and thank you everyone else for carving out a few minutes with us on Friday today here. And remember to log in the Kay Properties Marketplace, www.kpi1031.com, to view 20 to 40 different DST offerings from 25 different DST sponsored companies. Call us 855-899-4597 to speak with a Kay Properties representative who can walk you through your options. Thank you again, Matt, for all the information you share with us. Join us next time on DST Essentials with Kay Properties, an in-depth look at the various aspects of the DST 1031 exchange investment process.